Assalamu alaikum wa rahmatullahi wa barakatuh. Dear brothers, thank you very much for joining us tonight. Inshallah, we're going to be delivering a talk on Islamic finance with a particular focus on Islamic home finance. My name is Raza Ullah. I'm the CEO and founder of a company called Pfida. Pfida, many of you know, you recognize the word Pfida. It means goodness or benefit in many different languages, including Arabic, Urdu, Hindi, Punjabi, Turkish, Persian, lots of different languages. And our name Pfida has a P at the start because we want to, inshallah, put people first. And that's a very short spiel about why we exist, to bring Pfida to the people. So Pfida is an Islamic home finance company, but we're not here today to just talk about Pfida. We're here to really provide a very educational session, a beginner's introduction into Islamic finance. What are the range of options available? What are some of the fiqh considerations to understand around Islamic finance, which my colleague Sheikh Salman will talk to you about, inshallah. And then what are the different products available, starting from the very basics, starting from a mortgage. How does a mortgage work? Talking about Islamic bank mortgages, talking about shared ownership products, and also talking about the Pfida product. And we'll do a compare and contrast across the different products available. And the idea by the end of today's session, inshallah, is to arm you all with the tools to understand the range of products available, so that according to your own needs, according to your own situation, and according to your own beliefs and what makes you comfortable, you can then go ahead and make the most informed decision when considering Islamic finance options, inshallah. So let's get started, Sheikh. Let's get on to the first slide. So a little bit about us. I've very quickly mentioned my name, Raza Ullah. So by background, I'm an actuary. By show of hands, who's heard of an actuary? 3 people, excellent. That's about the response I normally get. Actuaries aren't very widely known. An actuary is effectively a statistical modeler. So I worked all my life in the London financial markets. I worked for the likes of PwC, the Lloyd's of London marketplace, the Bank of England. And actuaries do complex statistical modeling. So we model risk for financial institutions, and we help them to understand how much money they need to hold based on thousands and thousands of simulations, how much money they need to hold to make sure that they can survive even in a very, very bad situation. Now, it's a pretty rare skill set. There's not many actuaries in the world, let alone in the UK. But as a result of that, actuaries tend to be quite highly paid, alhamdulillah. So when I was working in the city, alhamdulillah, I was earning very, very good money. I was in very, very senior positions. I progressed through my career very quickly, and alhamdulillah, I was very, very good at what I did. And I enjoyed my role. I had no reason not to. And I had no reason to leave my role. But rewind to 2015, when I was working at the Bank of England. And I was sat next to a young chap called Elliot Luciani Kane, a 21-year-old new graduate, non-Muslim chap, sat next to me. And I was boasting to this young boy, and I was saying to him, you know, Elliot, we actually earn a lot of money. And my plan is, by the time I'm 40, I'm going to own a property portfolio, and I'm going to retire off the rental income. Alhamdulillah, that was my plan at that point in my life. Elliot didn't think that was good enough. Elliot wagged a finger in my face, and he said, you know, Raza, what you're talking about is going to deepen the housing crisis we're already having. You're going to buy up housing stock, you're going to make houses even more expensive for the rest of us who are struggling to get onto the property ladder. Whereas with an actuarial skill set, you have a responsibility to fix it. Now, Elliot didn't say to me, you have the ability to fix it. That would have been a different story. He said, you have a responsibility to fix it. See the slight difference? Elliot, this 20-something-year-old, non-Muslim, fresh out of university graduate, was effectively schooling me in my Islam. And I thought, God, he's got a really good point. There goes my ambitions of owning a property portfolio. I actually have a responsibility here. So that finger wagging that Elliot did to me put a seed in my mind. And later that very same year in 2015, alhamdulillah, Allah invited me to his house and I went on Hajj. And whilst I was on Hajj, on the plains of Arafah, with my hands raised to the sky in the 50 degrees heat, standing under the shade of a lonely tree, I remember having a conversation with my Lord saying, Ya Allah, Ya Rabbi, you have given me everything I could possibly ask for in life. You've given me health, you've given me wealth, You've given me my iman, you've given me my intellect, you've given me this actuarial skill set, which very few people on earth possess. Ya Rab, what will I say to you on that day when you ask me what I did with it all? Ya Rab, how am I going to answer you when all I can say is that with the innumerable ni'mah that you've bestowed upon me, all I did was buy a nice car and buy a nice house and go on holidays and very occasionally give in charity. Ya Rab, I'm ashamed. I'm ashamed to stand in front of you on that day. And I realized, dear brothers, how ashamed I was of the answer I would have had at that point in my life. And I started crying and I started trembling. And I don't think I will ever cry and tremble like that again. It was 50 degrees and there was a puddle around my feet in the sand because I was so terrified of my Rabb on that day. And I just kept repeating again and again, Ya Allah, what will I say to you? Ya Allah, what will I say to you? Ya Allah, what will I say to you? And I realized I could not face my Lord at that point in time without having a better answer for all the countless blessings He's bestowed upon me. So that was the moment. People say Hajj is life-changing. And it's when you go on Hajj you realize exactly what that means. It was when I went on Hajj that my whole perspective in life changed. And I realized at that point on Arafah that I wanted to be able to say, at least, Ya Rab, I tried. I tried to do something to please you. Maybe I failed completely, but I tried to do something to please you with the countless ni'mah you have given me. So that was the point in my life when I decided I needed to try and do something about it. I came back from Hajj. I ended my very, very lucrative role at the Bank of England, and I decided I needed to do something. So I didn't really have a plan at the time, but I ended my role, and I actually had a conversation with my wife. My daughter, our firstborn, had literally just been born when I handed my notice. And I had to have a conversation with my wife and say, you know, we're used to a very good lifestyle, but maybe all that's going to change and you have to be very patient with me now. Alhamdulillah, our wives are very patient and forbearing. And so I didn't have much of a plan, and I sat at home and I decided, what am I going to do? And I thought about doing charity work, and I realized actually there's plenty of good charities in the world. And then I rewound to the conversation with Elliot, and I thought, right, the housing market, this is where maybe I can have an impact. And I started setting up the business that we call Pfida today. And inshallah, later in this presentation, I'm going to take you through how our model works. But before that, we're actually going to spend a lot more time talking about how all the other range of products on the market are structured. I'm going to let Sheikh Salman quickly introduce himself, and then we're going to get straight into it, inshallah.
Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Salman Hasan. I am by training a lawyer. I trained in one of the big top 10 law firms in the City of London in Islamic banking and finance. That's all I did. So I didn't do conventional banking and finance. I only practiced Islamic finance. Now my background is, after I graduated with a law degree, I trained at the bar, so I became a barrister, and then I wanted to actually study Islamic law. And prior to that, I'd already started learning Arabic, and actually I started studying with a sheikh in London. He was a sheikh who studied in Syria, and I used to go to his house a few times a week to study, and I started studying Hanafi fiqh and Nahu and Sarf. So by the time I graduated, I was already fluent in Arabic, and by the time I graduated, I went to Syria and I effectively did a second degree, a BA Sharia program in Damascus at a place called Masjid Yusuf. So I married together knowledge and experience of English law and Islamic law, came back, joined a law firm, and practiced only Islamic finance. Now, the thing that filled me with a lot of discomfort was when I was working in the English law firm, I saw that as an opportunity to apply all of the fiqh al-mu'amalat, the Islamic principles and rules and regulations relating to contracts and sales and financial transactions. I saw that as a great opportunity to carry on studying while working and getting paid for it. So it was like the dream job for me. But the thing that filled me with discomfort was all of these banks that we were advising. So all of the big banks that you see on the high street, many of them had Islamic finance windows, and also all of the Islamic banks in the Middle East. What they would do is they would come to us and they would say, here's a conventional product, like here's an interest-bearing mortgage. Can you create an Islamic version of this where you produce exactly the same economic or financial outcome, but do it using Islamic contracts? So do it using contracts called musharaka or mudaraba or wakala or any of those traditional Islamic contracts. But you take those, but you tweak them, but produce exactly the same financial outcome as an interest-bearing mortgage or an interest-bearing loan or other interest-bearing financial product. Now, who in this room would feel very uncomfortable if that was required by your job? Would you be happy about that? You wouldn't. So you have a natural fitrah, you have an instinct that says that can't be right. And I thought to myself, I didn't study the Sharia to then use that knowledge to enable and help other people to circumvent and get around it. That's not why we study Sharia. So the Maulana said here, you don't study Sharia for that reason, do you? You study Sharia to apply it in your life and then to advise other people how to apply it in their lives. That's why you do it. You don't do it for this reason. And so that's why I was very uncomfortable. And like Raza, I came to a point after several years where I decided that I'd learned enough. Because before I went in, I knew it's a dicey business. I went in with my eyes open. I spoke to some of my teachers and I said, this is an opportunity. What should I do? They said, you should go into this industry to learn the trade, to learn the skill of how to be an Islamic financial lawyer, to marry together your knowledge and skills of English law and Islamic law, learn the trade, and then leave and try to do something more authentic and genuine and of great service to the Muslim community. So that's the mandate with which I entered this profession. After several years, I felt that I'd had enough. And so I also handed in my notice and resigned. Now, sometime after this, Raza contacted me and he said, I've left my job at the Bank of England. This is what I want to do. Would you like to support me, help me? And for me, this was a dream come true. I was looking for this opportunity. And so that's how we clubbed together. There's a history behind this. 10 years before that, when I was studying in Damascus, Raza was an undergrad. And I used to come back in the summer holidays and teach Arabic. And Raza was a student in one of my Arabic classes 10 years prior to that. 10 years later, we reconnected. We didn't keep in touch for 10 years. And he had now become a seasoned actuary. I'd become an Islamic finance lawyer. And Allah brought our skill sets together to complement each other, to enable us to do what we do today. And so that's just a brief background about me. I'm going to hand back to Raza, or am I next? So what I'd like to do in the next few minutes is give you a very brief, high-level summary. I'm not going to go into the detailed rules and regulations of fiqh, because that's going to be too complex and technical. But what I will do is give you a very high-level summary of the core principles of Sharia that underline how you would structure an Islamic, or an example of how you would structure an Islamic home finance contract to be genuine, right? So the first principle I'd like to invoke is actually based on a hadith of Rasulullah sallallahu alayhi wasallam, in which he said, it's very famous and it's actually become a maxim, it's become a qa'ida fiqhiyya, in which he says, al-kharaju sallallahu alayhi wasallam, al-kharaju bid-dhaman, which means that when you apply your money towards an asset or an activity and you wish to take a return from it, this is very important. You want to get something back for your money. So you put £100 somewhere, you want to get 110 back. That extra 10 is called kharaj. That's what you take out. Okay? What you take back, your return, your profit. He says, al-kharaju bil-dhaman. Dhaman means that you take risk in the possibility that you could lose the £100. Okay? So what gives you the right to take a return is the fact that you took risk in your capital. This is very important. This is a fundamental principle of the Sharia. Yeah? The Sharia does not allow us to take a return where we don't risk our capital. So for example, if I were to lend somebody £100, they owe me that £100 back, for example, say after a year. I give somebody £100 for a year. After a year, at the end of the year, do they owe me £100? Yeah? Even if they've lost £100. Suppose they lost it. They got pickpocketed. Do they still owe me the £100? Yeah. So did I risk my capital? Did I take the risk of the pickpocket? No, he did. Right? Or if it fell out of his pocket and the wind blew it away, did I take that risk? I didn't, he did. Or if he invested it in something and he lost it, he didn't make any money, in fact, he lost his capital. Did I take that risk? No, he did. So I didn't take any risk in that capital. The borrower did. Does the Sharia give me a right to take a return out of that? No. And if I demand an extra £10, that's called riba. In English, we call it interest. Okay? Now, some people argue, well, actually, you did take a risk because you took the risk that he was unable or unwilling to pay you at the end of the year. Is that a risk? At the end of the year, maybe he just doesn't have any money. Or he's got it, but he's just not giving it to me. That's called credit risk. Yeah, we've got are you an auditor? Yeah, we've got an auditor over there, so he's nodding his head. That's called credit risk. Credit risk is the risk that he's unable or unwilling to pay you. Does the Sharia allow us to take a return for taking credit risk? No. So the risk we're talking about here, the daman Rasulullah ﷺ is talking about here, is asset or commercial risk. Asset risk is commercial risk. It's risk in the asset or the activity. This is very, very important. Not the credit risk. There's two types of risks. So commercial risk and credit risk. So al-kharaj bil-daman. This is a very, very important principle. So if you see a structure or a contract where one person is giving the other person money, the other person ends up owing that money back to him or her at the end of a period of time, and has to give a bit of money on top, right? What's the telltale sign there? There's credit risk, not commercial risk. They owe the money back. There's a debt, right? And there's money on top. There's kharaj. There's a red flag here going on, isn't there? There's probably some sort of interest or riba going on. So that's the first principle. Now, sometimes you could have a situation where someone hasn't given somebody a loan directly, but through one or two or three contracts, through an interaction, you get the effect of a loan. Let me give you an example. If you were to go to, suppose you want to buy a house. Let's use a really simple example. The house price is 100K, £100,000. You have £20,000. You need another £80,000. You walk into your high street bank, Barclays, HSBC, Lloyds, NatWest, whatever, and you say, excuse me, can you help me buy a house? I've got only £20,000. I need another £80,000. The bank will say, well, I'll lend you the £80,000 and I'll charge you interest. And you say, well, that's contrary to my faith. I'm not going to do that. So I'll go to an Islamic bank. You walk into the Islamic bank, and I believe Islamic banks no longer operate in Scotland, but at one point they did. Now you go to the Islamic bank and you say, can you help me? They say, well, we can't lend you the money and charge you for that because that's not allowed. But let's do this. Let's go into a co-ownership. Let's own the property together. Okay? This is called musharaka or sharika, a partnership. So on day one, the bank owns 80%, you own 20%. So far, so good. It's a beautiful contract. Yeah. In fact, musharaka or sharika is fundamentally an Islamic contract. What the bank then says is, well, we want certainty that we'll get our money back. So what we'll do is we'll require you to buy our share, the 80%. We require you to buy it for exactly £80,000, but we'll give you credit. We'll allow you to pay it over 20, 25 years. Okay? So on day one, you sign a contract on that very first day that I agree to buy your share of the property for exactly £80,000 in installments over 20 years. What's happened now? They've effectively sold their share to you, right? And they've allowed you to pay that on credit. Does that make sense? Again, so far so good. Is there a problem with that? No. In fact, if that's all there was, you'd be a very happy bunny. You'd be like, thank you, because it's not costing you any more than the price of the house, right? That effectively would become what you might call an interest-free loan. Yeah. So in a roundabout way, they've created the effect of an interest-free loan. Firstly, by buying the house together with you, and then immediately selling their share to you for installment payments. Do you see that? Can you see that? Yeah. So you now have an interest-free loan. Is that a debt obligation on you? do you owe the bank a debt now? You do. Can you see that? They've passed on the risk of the house to you. If anything happens to the house now, whose risk is it? Yours or the bank's? It's yours, because you'll still owe the bank the money. They've passed on the risk and sold their share to you. That's very important to understand. Now, the problem here is that there's a third contract in this matrix. The third contract is like this. The bank says, well, until you've paid us those installments in full, and because you're going to live in the house, and we can't rent it out to someone else, until you've paid us, we're going to charge you rent on our share. Some of you might be scratching your head thinking, well, the bank doesn't have a share. They sold it to you, right? And they passed on all the risk to you. The bank actually, factually, no longer has a share in the house in terms of risk. You take all of the risk. And so what the bank is doing is it's charging you rent effectively on top of a debt. Let's say that again. You owe the bank a debt of £80,000, and the bank, until you've paid that to the bank, they're charging you rent on top of that debt. So what is rent on the debt? What would you call rent on the debt? Some of you, the penny's dropping now, right? See what's happening. So in a roundabout way, by charging rent on the debt, some scholars say this is not an acceptable practice. Other scholars say it's not ideal, but we're going to allow it in order to enable Islamic banking to get off the ground. And we're going to go into a bit of that in a moment, into why some scholars allow it, why some other scholars don't. But what I wanted to do was arm you with the information so that you can understand the mechanics of how that works. Okay? The key problem is that a debt is created. The debt requires you to pay the bank back a certain amount of money, and then there's an amount, there's a kharaj on top of the debt. There's a profit on top of the debt, which they call the rent. Right. So now, what if you, actually before that, can you see here, this situation is created by combining two contracts of sale. Yeah. So the first contract of sale is that the bank sells you their share. That's a contract of exchange. The second contract of exchange is the rental contract, where the bank then rents their share. So they sell it to you, they sell you their share, then they rent you their share. So they're kind of selling you the same thing twice. Does that make sense? Which is a bit of a logical conundrum. It doesn't really work. It doesn't square. But let's put the logic aside. So the combination of two sale contracts in one goes back to another hadith of the Prophet ﷺ, in which he forbade. The hadith says, "Naha Rasulullah sallallahu alayhi wa sallam an bay'atayn fi bay'ah." That the Messenger of Allah sallallahu alayhi wa sallam, he forbade the combination of two contracts of sale in one. And it's for this very reason. It's for this reason because two contracts of sale can be combined, if they're rigged and linked together, can be combined to create the economic outcome of an interest-bearing loan. And this is the exact technique that we were practicing as lawyers in the big law firms. All the banks were coming to us and asking us to apply these sorts of techniques to create financial products for them that were labeled as Islamic, but were actually replicating interest-bearing loans in effect. And that's what filled me with a lot of discomfort.
Can you give an example of precious metals?
Right, okay. So actually the most common way to do this is much simpler than the technique I've described. The most common, probably 80-90% of the Islamic finance industry globally uses a technique which goes like this. So suppose you go to the bank and you want to borrow £100 and the bank wants to charge you £10 on top of that. Okay, so you want to borrow £100 for a year, and at the end of the year, the bank wants you to give them back £110. Now they can't lend you that money and then charge you interest, can they? Because they're an Islamic bank. So what they'll do is they'll say, right, okay, let's take a commodity like my phone. Okay, so I'm the bank, you're the customer, and this is my phone. So I will sell you my phone for £110 now. Okay, so you take my phone, but I'll give you credit. You owe me £110 in a year's time. You get that? So now you have the phone, and you owe me £110 in a year's time. Then you sell the phone back to me for cash. So I take my phone back, and then here you go. I give you £100 cash. You see that? So what's the net effect? You now have £100 cash and you owe me £110 in a year's time. You see, you just combine two sales, a credit sale plus a cash sale. You combine those two together and you can create any interest-bearing outcome. It's very, very easy. And then there's some scholars who say that, well, that's too easy. You can't just buy and sell, because actually this is forbidden in the hadith. This is called bay' al-'ina. It's a type of sale which is forbidden by the Sharia. It's called bay' al-'ina. It's a sale and buyback. It's not allowed. So, what some scholars say is, well, you're not allowed to do this. So what you can do is you can use a phone shop in the middle. All right. So what I will do is, I'm the bank. I will buy the phone off the phone shop for 100, sell it to you for 110 credit. Then you sell it to another phone shop for 100 cash. And then in the background, the two phone shops have an arrangement where they pass the phone back to the original phone shop. So now, instead of doing it directly, you've now got these two brokers in the middle, phone shops, who supply the phone and then rotate it. And so you have this sort of merry-go-round of phones or metals or palm oil or whatever commodity you wish to use. But can you see, it's just achieving the same outcome using more people in the matrix. All right? So that is what filled me with a lot of discomfort. Okay, despite the fact that there are fatwa and there are scholars who have permitted these things grudgingly, not willingly, not encouragingly, but and they have always encouraged the Islamic finance community to move towards true Sharia-based products, towards authenticity, and that's very, very important. And so we see that what we do as an answer to that call to move towards authenticity. Yeah. That's a brief background about myself and also about some of the core principles that I think everybody should know about how Islamic finance works and how to identify red flags and how to look for genuine, authentic products. Now, there is one thing that we could do in that arrangement that I described earlier. What if you had a situation where, suppose you rent. Okay, I rented for many years. Suppose you rent and your landlord's a really nice guy. And one day your landlord says to you, you know, Muhammad, Abdullah, Hassan, I really like you. If you want to buy this house off of me, then I'll sell it to you. And I'll sell it to you for my cost price. This house now costs $500,000. 20 years ago, I bought it for 100,000. I'll sell it to you for 100,000. Would that be a dream come true? Yeah. Problem is you don't have 100,000 at the moment, right? So then your landlord says, you know what, I'm a really, really nice guy, and you're a really nice guy. You can buy it monthly in installments if you want. So just pay me monthly, and it's still 100,000. You can take 20 years to buy it. How do you feel? It's amazing, right? Yeah. So each month, your only obligation is to just pay the rent for living in the house. Right, and if you bought some share, you'll only pay rent on your landlord's share. And if you want to, you don't have to. If you want to, you can offer to buy a share of the property. You can pay an installment towards the house, and then you become the owner of the house over time. So can you see in this arrangement, it's a simple landlord-tenant relationship, but you have a friendly landlord who, if you want to, but you don't have to, no obligation, no debt. If you want to, you can offer to buy more of the house. And his policy is to sell it to you at his cost price. That's an amazing arrangement, okay? And that's totally based on Sharia because there's no debt. There's no obligation. You don't owe the landlord anything. He doesn't owe you anything. And that's effectively the kind of structure, and Raza's going to drill into a bit more detail that we've structured at Pfida. So we've taken this co-ownership model and we've taken the debt element out of it. That's the key thing. And therefore the rent is genuine rent, and the flexibility is genuine flexibility. You have the option, but not the obligation to buy more of the landlord's share of the property. I'm going to hand back to Raza, who's going to now drill into details about all the different options available out there, including conventional mortgages, Islamic mortgages, and shared ownerships, and the Pfida model, so that you're armed with all of the information that you need to look at your options. Jazakumullah khair.
We'll take questions at the end, inshallah, if that's okay. Jazakallah khair, Sheikh. So, quick test, just to see who was listening. And it's not hard. When you're renting a property from a landlord, is that rent or riba? Hands up. Rent. When you take a mortgage from a bank and you're paying monthly installments, is that rent or riba? How do you know? How do you know? Before we even did this talk, you would have been able to tell me those answers, right? It's obvious. But why is it obvious? How do you know when you're renting a property from a landlord, your nafs just feels comfortable? You know, I'm paying rent. I'm not paying any riba, I'm paying rent. And when you're borrowing a loan from a bank and you're paying the installments on that, your nafs doesn't feel comfortable. You know this is riba. Inherently. You don't need to be a Sharia scholar. So what is it about those two arrangements that on the one hand, you just know this is rent? Alhamdulillah, there's nothing wrong with this. And on the other hand, you just know this is riba, astaghfirullah, I shouldn't be doing this. How do you know? Let's put it to you this way. Let's see if you're paying attention. When you're renting a property from a landlord, who takes the risk in the property? Landlord's taking the risk in the property. According to Sharia, if the landlord is taking risk in the property, is he entitled to a return? Yes. So this is halal. This is rent. This is trade. When you borrow a mortgage from a bank, is the bank taking risk in the property? No, they're taking credit risk in you. They're not taking risk in the property. According to what Sheikh Salman told us just now, if the bank is not taking risk in the asset, is it entitled to a return on that asset? No, this is riba. Khalas, that's it, that's our talk to. You know everything you need to know. Wallah, that's it. I'll go through it and none of it will be a surprise to you now, inshallah. As long as you understand those two principles, your nafs is already comfortable with rent. Your nafs knows when you're paying rent. And your nafs knows when you're paying riba. Follow your nafs, you know. As long as you follow those principles, why is the landlord entitled to charge rent? Why is this halal? Because he is taking risk in the property. He deserves a return for that. Why is the bank not entitled to charge riba on the loan? Because the bank is not taking risk in the property. The bank doesn't deserve a return on that. This is Sharia 101. As long as you understand these principles, you will not go wrong, inshallah. Let's get into it. Sheikh, let's get on to conventional mortgages. Bismillah. So how does a conventional mortgage work? And apologies for the blurry slides. It's because we've had to really tilt the projector up a lot. So apologies if the bottom isn't that legible. So how does a conventional mortgage work? And again, there's a lot of words in the slide, but don't worry too much about the words in the slide. Conventional mortgage, you go to the bank, you borrow money from the bank, you use that money to buy the property. The property now belongs to who? When you buy the property with a mortgage, who does the property belong to? You. You buy the property. The bank gives you the money, you give that money to the seller, you take the property. You own the property. The bank uses that property as collateral, right? You now owe the money back to the bank. It's a loan. You owe the money back to the bank as a debt, and you have to pay interest on that debt. And you have to pay installments on that debt with interest. And every month you have to pay the installments and you have to pay the debt off by a certain period of time. What happens if the property is destroyed? Who takes the risk? You or the bank? You. So if you owe the bank hundreds of thousands of pounds and the property is destroyed, you still owe the bank hundreds of thousands of pounds. The bank does not take risk in the asset. No matter what happens to you, no matter what happens to the asset, you still owe hundreds of thousands of pounds to the bank. Who here knows what the word mortgage means? Exactly. Who knows what the word mort means from French? Mort. Death. The word mortgage means death grip, brothers. Just think about the audacity of this product which is sold to people. Banks are selling a death grip to people because when you take out a bank mortgage, you're taking out a debt worth hundreds of thousands of pounds that will follow you to the grave. Until you have paid it off, that debt will follow you to the grave, no matter what happens. And even if you die, what will happen to that debt?
You have insurance, basically.
You can take out insurance. You can take out insurance. If you don't take out insurance and you die, what happens to the debt? The bank can seize the property, but actually before that, the debt passes on to your family, to your estate. So even after you die, the debt still carries on. This is a mortgage, dear brothers. Let's move on to the next slide. So to summarize a mortgage, I'm not going to spend too long because you guys already know how mortgages work. There are some pros of mortgages. There's lots of providers providing them, and they're financially regulated. Why do mortgages need to be regulated? Why does the Financial Conduct Authority regulate mortgages? Bearing in mind what the definition of mortgage is. If you're taking out a debt worth hundreds of thousands of pounds that's going to follow you to the grave, if that's the wrong product for you, could it ruin your life? Yeah. It's a debt worth hundreds of thousands of pounds. If it's the wrong product for you, or if it's not managed well, it can, and in many times does, ruin lives. Debt ruins lives. There's a charity called Step Change. They're a problem debt charity, and they did some research, and they concluded that problem debt costs the UK economy over £8 billion per annum. I've got an announcement, brothers. There's an Audi, red Audi, SK21 HJZ. Your lights and engine are on. So if that's your car, you may wish to go and check it. So if you take out a mortgage worth hundreds of thousands of pounds and it's the wrong product, it can, and in many cases does, ruin lives. So Step Change, this problem debt charity, they concluded that problem debt costs the UK economy over £8 billion per annum. This is the cost of people who cannot afford to keep up with their mortgages and other forms of debt. This is the cost of family breakdowns, cost of people losing their jobs, cost of mental health breakdowns. Around a quarter of homelessness on the UK streets is caused by problem debt, people not being able to pay their mortgages, right? This is why mortgages must be heavily regulated. This is why the regulator takes a particular interest in mortgages. What are the downsides of mortgages? The cons? Well, they're debt-based. And if you're paying a return on a debt, that is pretty much the definition of riba. You have very little flexibility with mortgages. Let's say you take out a mortgage and you're paying £1,000 per month, and now you get promoted and you want to start paying £1,200 per month. Can you do that? No. Because the bank wants to make a set amount of money off of you over a set period of time. So if you overpay by too much, they'll charge you an early repayment fee. They'll fine you for wanting to get rid of this death grip. They'll fine you, they'll penalize you for wanting to remove this death grip. So if you want to actually increase your payments to £1,200 per month, you have to go and apply for a brand new mortgage product. They won't let you do it easily. And similarly, if you're facing hard times and you need to reduce your payments, no flexibility. One of the big drawbacks of having a debt-based product. Okay, current providers, lots of them, you know them all. The high street banks, HSBC, Barclays, Lloyds, the building societies, Halifax, Nationwide, and then some non-bank providers like Click Mortgages and Virgin Money and stuff like that. Lots of providers. Now this chart is quite interesting, and apologies, I know it's very blurry, but this is the ownership profile. So you can see the blue bar is your ownership in the property, right? So from day one, your ownership is 100%, and your ownership remains 100% all the way through to the end. You own the property, hooray, alhamdulillah. Do you have 100% of the rights over the property though? Do you even have the first rights over the property? Who does? The bank. Your ownership is just a signature on a paper, but actually the bank has more right to your property than you, because they take your property as collateral and they take what's called the legal charge of your property. And this means that they have more right to your property than you do. So your ownership is really just imaginary. Until you've paid off the debt, although your name's on the title, actually you don't really own the property until you've paid off that debt. Okay, that's a mortgage. Let's move on. Islamic bank mortgages. This is where it starts getting a little bit more interesting. And apologies for the feedback. I'm going to try putting this here. Can you still hear me? That's actually no better. That's a bit better. Okay. Okay, so Islamic bank mortgages, this is where it gets a little bit more interesting. And Sheikh Salman talked a little bit about these already. So with an Islamic bank mortgage, rather than the bank lending you money and you taking that money and using it to buy the property yourself, with the Islamic bank mortgage, they buy the property with you. So they buy the property with you, and then they say, right, you must now buy our share of the property off of us for a set price over a set period of time in set monthly installments, right? And think of it this way. In a partnership, so it's called a musharaka, it's called a diminishing musharaka. That's the phraseology that the banks use. A diminishing musharaka, which is a reducing partnership, because their partnership share reduces over time. In a partnership, let me ask you a question. If myself and brother auditor, what's your name? Azhar. If myself and brother Azhar buy a car together, right? You and I buy a car together, and we both jointly own that car. I haven't loaned you any money, and you haven't loaned me any money. We're partners in this car, right? We both just pooled our money together and bought this car together. If the car is destroyed, can I say to you, Azhar, you have to now buy my share of the car from me? What will you say? No, what car? There is no car. I don't want to buy your non-existent burnt-out car. I can't force you to buy my share from me. Even before the car is destroyed, if we have a partnership, can I say to you, Azhar, you must buy my share from me? No. You might want to offer to buy it from me, right? But I can't force you. I can't say to you, Azhar, forget the car. I own... Bad example. I own a phone, right? Can I say to you, Azhar, you have to buy my phone off of me. And if you don't buy it from me, you're a very naughty man. Can I say that? No. I can say, Azhar, would you like to buy my phone from me? And here's how much I'm willing to sell it to you for. And you can say, sure, I'd like to buy it. Or you can say, actually, I've got a phone. I'm okay, right? So similarly in a partnership, there is no obligation, right? I can't force you to buy my share from me, and you can't force me to buy your share from you, correct? That's a partnership. And if the property is destroyed, who takes the loss in a partnership? Both of you. That's a partnership. Whereas if I say, Azhar, if the car is destroyed, you must immediately buy my share off of me for the exact price I paid. Is that a partnership or is that a debt? That's a debt because you owe me that money no matter what happens to the asset. Correct? Okay, so now we know the difference between a debt and a partnership. Risk sharing. Risk sharing is one of the fundamental principles of partnership. And offer and acceptance. In a partnership, each partner can offer to buy out the other partner, but with no obligation. It's offer and acceptance. Okay? Risk sharing, offer and acceptance. These are two key fundamental principles of an Islamic partnership. Right, now let's, with that in mind, think about how do Islamic bank mortgages work. And I say this to educate you, not to insult other products, not to say other products are halal or haram. Much more knowledgeable people than me, very, very reputable Sharia scholars, have approved Islamic bank mortgages. I want to start with that. We'll get into why in just a minute, because they're not perfect, as you'll see in just a minute. But there's a very good reason. So, with that in mind, with the Islamic bank mortgage, it's called a partnership. As Sheikh Salman mentioned, they will say, I can't lend you the money, so I'm going to buy the property with you. But you must now buy my share of the property from me every month for a set price over a set period of time. Remember what we said in the car? Can I force you to buy my share in a partnership? No.
No.
Okay. And if the property is destroyed, we, the bank, are not going to take that risk. So if the property is destroyed, you must immediately compensate us for the property. What did we say in the car? Can I force you to buy my share if the car is destroyed? No. So is it really a partnership? Okay, that's the thing to think about. Let's go on to the next slide. So with those things in mind, how does an Islamic bank mortgage work? What are the benefits? Well, one of the key benefits, they are approved by a panel of Sharia scholars, very reputable Sharia scholars, very well-known Sharia scholars, many of whom are actually Sheikh Salman's teachers and Sheikh Salman's friends, and he has a lot of respect for them. But it's okay for Sharia scholars to have different opinions and to disagree with each other. And Sheikh Salman, I don't want to speak for Sheikh Salman, but Sheikh Salman does not agree with Islamic bank mortgages in their fundamental principles, because they actually end up breaking the principles of partnership in the way they're structured, right? But why are Islamic bank mortgages approved by Sharia scholars? There's a very good reason. The Sharia scholars approved them on the basis that the harm of not approving them outweighs the harm of approving them. Because if Sharia scholars said conventional mortgages are haram, Islamic mortgages are haram, what would happen? Muslims wouldn't be able to buy homes. And Muslim wealth would decline more and more and more. Already many Muslims self-exclude because many Muslims, just like myself and Sheikh Salman, the reason we set up Pfida, many Muslims don't feel comfortable with Islamic bank mortgages. But at the same time, we have to weigh that up against the over-societal impact of Muslims just stopping buying homes. Because wealth is heavily correlated with home ownership. And family health and mental health and earning power are all heavily correlated, and educational outcomes all heavily correlated with home ownership. There's lots of data to prove this. So the Sharia scholars realized, actually, if we don't let Muslims buy homes, Muslim wealth is going to decline and Muslims are going to fall behind. And so when the Sharia scholars did approve Islamic bank mortgages, it was on the principle that it should be a temporary dispensation in the pursuit of then seeking more pure products. And as Sheikh Salman mentioned, this is what we seek to do with Pfida, take Islamic finance to the next level and seek the next level of purity, inshallah. But nonetheless, alhamdulillah, they are halal because they are approved by reputable Sharia scholars. But we are here to arm you with the tools to understand what's under the bonnet, and then you can make your own decision, alhamdulillah, right? Depending on the scholars you follow and depending on your own beliefs and where you draw the line, you can make your own decision, inshallah. We're not here to say, don't go for this or do go for that. We're just here to arm you with the tools, inshallah. Another benefit of Islamic bank mortgages is, although they do still charge late payment fees, because late payment fees are actually not permitted, what they do is they then donate those to charity rather than keeping those for themselves. And finally, they are also regulated and fairly well established. Now, what is the red flag with them being regulated? It's counterintuitive. You almost think, well, they're regulated, that's a good thing, right? But what is the red flag with them being regulated? What did I say earlier about why are mortgages regulated? Who can remember? Exactly. Because it's a lifelong debt that can ruin your life if it's not managed properly. So the fact that Islamic bank mortgages are regulated, there's a reason for that. It's because it's the same problem. Islamic bank mortgages are ultimately still debt-based, right? You still have to pay a certain amount of money over a certain period of time. And that is a debt worth hundreds of thousands of pounds. And if that is not the right product for you, or if it is not managed properly, it can still ruin your life. That is why Islamic bank mortgages, just like conventional mortgages, must be heavily regulated.
I have one question.
Sorry?
Question.
Can we save questions till the end? Yeah, okay. There's only a few more slides. Some of the downsides of Islamic bank mortgages, as I mentioned, they're still ultimately debt-based products. There's no material risk sharing. As we mentioned, the Islamic bank contract will stipulate if the property is destroyed, you must immediately buy our share off of us for the price that was set at the beginning. And the rent that Islamic bank mortgages charge is actually benchmarked to interest rates as well. So it operates like a debt and it's priced like a debt as well. It's benchmarked to interest rates as opposed to being benchmarked to local property rent. Providers, well, here in Scotland, unfortunately, there's no providers. Actually, it may interest you to learn that Pfida is the only provider of Islamic home finance in Scotland, but we're quite small, we're still growing. But we do operate in Scotland and we have funded homes in Scotland. And actually one of the other masajids we'll be talking at tomorrow, inshallah, we just found out yesterday, the imam of that masajid has actually bought a home with us. Alhamdulillah, it's very, very nice to them. Ownership profile. This is a really interesting one. So you saw with the conventional mortgage, your ownership of the property is 100% from day one all the way through to the end. With the Islamic bank mortgage, it's the other way around. So the bank actually owns the property on title 100% until you make the very last payment. And when you make the very last payment, then the ownership of the property transfers to you. But do you have any less or more rights over the property compared to a conventional mortgage? No, actually identical rights. So what this shows is even though with the Islamic bank mortgage, your name isn't on the title, the bank's name is on the title, you still actually have the same rights over the property as you do with a conventional mortgage. Because actually with a conventional mortgage, even though your name is on the title, it's really a bit of a fiction. The bank still has first right to the property. And it's the same here. The bank still has first right to the property, but you still have rights to the property, to live in that property and enjoy that property. So actually, the purpose of highlighting that is don't get too hung up on whose name is on the title. That's actually not what's relevant. What's relevant is what's in the contract and what rights you have under the contract. That's actually far more important. Okay, that's an Islamic bank mortgage. Now we're going to talk about a product called shared ownership. And shared ownership products are relatively new, but they're now increasing in popularity in the UK. So shared ownership products are actually very interesting. From a Sharia perspective, you can't fault them. Shared ownership products actually are very halal from a Sharia perspective. How do they work? Not too dissimilar starting point from the Islamic bank. So rather than the shared ownership provider lending you money, what they'll do is they'll go into partnership with you in the property. You'll be joint owners, shared owners in the property. Now with the shared ownership, they don't have that clause which the bank stipulates. They don't require you to buy their share from them over any period of time. It's offer and acceptance, which is exactly how it should work under a partnership. And if the property is destroyed, they will take the loss with you, which is exactly how it should work under a partnership. So shared ownership is actually a true Sharia partnership. And there are many non-Islamic providers, generally housing associations and local authorities, who offer shared ownership products. And they're very, very Islamic from a Sharia perspective, but there are some pitfalls to be aware of. And I'm going to explain those on the next slide, inshallah. So with shared ownership, the pros are they are debt-free, genuine partnership. They genuinely share risk with you. They have less strict entry requirements than banks. So generally you can buy a larger property with a shared ownership than you can with a bank. Can anyone tell me why? Why can you go for a higher property value with a shared ownership when there's no obligation to buy their share from them?
Bank holds the shares. Bank holds the share and they won't bother investing more into it.
Exactly. Very good. So when the shared ownership provider does your credit assessment, they're only assessing your ability to pay your rent. They're not assessing your ability to buy their share from them. Whereas when a bank assesses your credit, they're assessing your ability to pay the interest and repay capital. Or in Islamic bank's case, pay the rent and buy their share every month. So that's a higher threshold. Whereas with shared ownership, they're just assessing your ability to pay rent. And as a result, your monthly payments are lower because you're not buying equity every month, you're just paying your rent. And as a result of that, you can actually afford a larger property, but it means that to actually get to full ownership is much harder because you're using all of your income just to cover your rent. You might not have much left over to actually buy equity, right? So one pitfall to be aware of. Don't get too caught up on the fact that you can go for a bigger property. You need to think about how you're going to get to full home ownership with shared ownership. Some of the cons, some shared ownership contracts have very penal clauses. They can be very, very harsh if you miss a payment. To the extent that some shared ownership providers will even have a clause saying if you miss one rental payment, they can take the property away and give you nothing, right? So it will vary by provider, but if you are considering a shared ownership type property, and I don't know if there are shared ownership providers in Scotland, you'll have to do your research on this, but if you are considering shared ownership, my advice is to make your solicitor work hard. Conveyancing solicitors will generally, they're very busy people, right? And they'll generally try and get away with doing the least amount of work possible. Sorry if there's any conveyancing solicitors in the room, but they'll generally try and do the least amount of work possible. It's you who's paying them. So you have a right to demand that you get your money's worth from them. So you should be telling them, no, you need to explain to me exactly what this contract means, and you need to explain to me exactly what risks I'm entering into. Because if there's a clause saying that if I miss one payment, I may lose my house and have nothing, I need to know about that. So what I recommend is, if you are considering this, make your solicitor work hard. Make sure you know exactly what you're getting into. They can be very, very expensive. The reason being, well, let's see. What do property values in the UK tend to do year on year? Increase. How much? Year on year property value increase, who knows? 2 to 5%? Actually, it's more than that. On average, long-term average property price value increases are 5 to 10% per annum across the board, right? And in Scotland right now, it's crazy. It's even higher than that, right? Scotland is like the opposite of the rest of the UK. The rest of the UK, the market's very flat at the moment, whereas Scotland is just going up and up at the moment. So property prices, on average across the board, tend to go up 5 to 10% per annum. What do wages tend to do? How much do wages go up by year on year, on average, long-term wage inflation? Anyone know? 1 to 2%. On average, 1 to 2% per annum across the board. And if you're a nurse, probably negative, right? So if the cost of buying equity from your shared ownership provider, because they will, when they sell equity to you, they will revalue the property. Now, if the property is going up 5 to 10% per annum, but your wages are only going up 1 to 2% per annum, is it becoming more and more unaffordable over time? It is, isn't it? And that's the problem with shared ownership. As a short-term stepping stone, fantastic, completely halal, can't fault it. But you need to be aware of the practicalities as well, because longer term, if they're revaluing the property and your wages aren't keeping up with property price inflation, longer term, it's going to become harder and harder to ever get to full home ownership. And we get shared ownership providers coming to us saying, I've been in my shared ownership property for 5 years. I own 20% of the property, and I now cannot afford to increase my share anymore. It's impossible. I will never, ever get to full home ownership. And even the rent I'm paying is now higher than if I was to just rent the property on the market, the full property. I own 20% of it, and even then my rent is higher than if I was to rent it on the market. So shared ownership, you just need to have a plan. How are you going to get to full ownership over time? Don't be, deluded by the fact that the payment is smaller right now and you can go for a higher property right now. You need to have a long-term plan. You need to understand after 5 years, after 7 years, after 10 years, when this property becomes super expensive, what is my plan? How am I going to get to full home ownership? Do I have a nest egg that I can rely on and then buy it out? Do I have friends and family I can rely on at that time? Is my earning power going to increase substantially? Am I in a professional role where I'm going to get more qualifications and earn a lot more? These are the types of questions you need to ask yourself. If you can't answer those questions, then you should be thinking about shared ownership as a short-term stepping stone rather than a long-term solution to getting to full home ownership. And we see many unfortunate Muslims getting trapped in this way because they haven't thought about the long term, unfortunately. Ownership profile, this chart needs to be fixed. It doesn't quite work, unfortunately, but the point sort of gets across. Your ownership profile doesn't increase. So with a shared ownership, your contract is to just pay rent every month. And the onus is on you. The shared ownership provider might give you 1 or 2 times a year when you can approach them and offer to buy more equity. And if you don't approach them, they won't remind you, right? So if you don't act proactively, your ownership share will never increase. And at the end of the term, your ownership will be exactly what it was at the start, unless you save up and remember to approach them within the windows. So again, with shared ownership, very halal, but there's some practical elements you need to be aware of and you need to plan around, okay? So that's a shared ownership product in a nutshell. There are some providers in England, again, they don't operate here, unfortunately. Way Home, Your Home are the key ones, but they don't operate in Scotland right now. And to the best of my knowledge, they don't have any plans to either, unfortunately. Okay, we're going to talk a little bit about the Pfida product as well now. So with the Pfida product, what we've done is, rather than taking an existing product and try to rework it under a Sharia framework, what we've done is created a product from scratch. And we've taken the best of shared ownership, and we've taken the best of mortgages, and we've tried to wrap them together into one beautiful product. So with our product, it's a partnership, just like a shared ownership. We buy that property together with you as partners. You own part of the property, we own part of the property. You only have one obligation, which is to pay your rent on the share that you don't own. That's your only obligation. And take reasonable care of the property as well, of course, just like renting any other property. So there's no debt. You don't have to buy us out. You can choose to buy equity from us as much as you like, whenever you like, or not at all. And we help you to do that through our tech, through our app, which I'll get to in just a minute. We facilitate that and we empower you in a way that no other product empowers you to do that. We genuinely share the risk with you. If the property is destroyed, you don't owe us anything. We take the loss with you shoulder to shoulder as your partner. And it's actually quite an affordable product. So people are used to thinking about Islamic finance as costing more. One thing we're very proud of at Pfida is that we've designed a product where for many customers, and it's not for every customer, I have to be honest, it will vary by property, by location, and by individual. But for many customers, we are able to charge a rate that actually is very competitive, even with conventional mortgages. And that's one thing we're extremely proud of. And you can go onto our website and you can create an account and you can check our cost calculators and you can see for your specific situation what it would cost. We're very confident that it costs no more than an Islamic mortgage, but in many cases, it's even competitive with a conventional mortgage. So it's a very affordable product. But on top of that, we know our customers aren't coming to us just to rent. We know our customers are coming to us because they want to own their property. So what we do is we help you and we actually incentivize you to get to full home ownership. And the way we do that is through a very clever mechanism called our rental discount. So let's say the property is a £100,000 property and you own 50% and we own 50%, just for argument's sake. And we say, okay, the rent on this property ordinarily would be £1,000 per month. And by the way, we don't benchmark to interest rates. We base it on actual rental market. So let's say the rent on this property would normally be £1,000 per month. But because you're a 50% partner, you're only going to pay rent on our 50%. So your rent is £500 per month. Now you can just pay £500 per month rent. That's just the fair rent to pay just for renting our share of the property. But we want you to get to full home ownership. And if you say, right, I want to fully own my home after 30 years, we'll do some maths and we'll say, right, to achieve your goal, here's how much of our share you would have to purchase every month. And if you stick to that, you'll fully own the property after 30 years. You don't have to stick to it. You can go higher, you can go lower, you can throw it out the window and just pay rent, entirely flexible. But that's the maths to help you understand your goal, right? Now we want you to stick to that goal. So what we do is we say, whenever you stick to that goal, we're going to give you a rental discount. And that's your incentive to stick to your goal. So we'll say to you, right, your rent on its own is £500 per month. But if you pay a little bit more, and I'm just using made up numbers, by the way, if you pay a little bit more, let's say £600, right? In any month where you pay your target payment, which is £600, we're going to give you a rental discount. And that rental discount is typically at least 5 to 10%. In some cases, it can be even as high as 30%, and it varies by location. So let's take a 30% example. In any month where you pay £600, instead of charging you 500 of that as rent, we're going to knock 30% off of your 500 rent. So we're only going to charge you £350 rent in that month. And the remaining £250 is all going to go towards equity purchase. So you see, if you just pay rent, you pay £500. But if you pay a little bit more, your target payment of 600, you'll only pay £350 rent in this example, and the rest will go to equity purchase. And that's your incentive. That's how we encourage you to stick to your target payment and get to full home ownership. But the point is you don't have to. And what this means is it's a very clever pricing model. It means when you're treating it like a rental product, you're just paying rent, you pay rent in line with the market. That's the fair rent to pay just for renting the property, right? But when you're treating it like a mortgage product and you're buying equity every month, we'll give you that discount, and now you're paying a rate in line with mortgages. Do you see that clever mechanism? So it means that unless you genuinely just can't afford to pay your target payment, you'd be silly not to, because you get a nice rental discount whenever you do so. And that's how we encourage you and get you to full home ownership, rather than you relaxing and just paying rent, which we don't want. We want you to get to full home ownership. So as a result, we've got a model that's very affordable, because although your target payment is £1,000, let's say in a given month, the car breaks down and you have to pay the mechanic and you've only got £800 in your pocket. Well, that's no problem. You can go into our app, you can reduce your payment to £800 for that month. All it means is you're buying £200 of less equity, and that's it, no problem. So you can just reduce your payment to whatever money you can afford. And let's say, astaghfirullah, na'udhu billah, Allah protect every single one of you. Let's say you lose your job and you can't even afford to pay your rent. Now what happens? Well, now this security buffer kicks in. We call it our equity buffer. So you actually have equity in your home. And we actually give you shares, proving your ownership in your home. Every time you buy equity, you actually get certificates. So if you can't afford to pay your £500 of rent, what we allow you to do is actually pay us using your equity. So you can actually sell some of your equity back to us to cover the rent that you owe. And in that way, you've got security. And let's put that into context. With a bank mortgage, if your total payment is £1,000, your interest plus capital, or an Islamic bank mortgage, your rent plus equity purchase, you have to hit £1,000 on the nose every month. And in any month, if you pay £800, you're in default, right? And the bank may give you a couple of months to make good on that default, and they'll probably charge you interest in between if they're a conventional bank. And after 2 months, they may take your house away from you and sell it. So when you're down on your knees, going through the hardest time of your life, the bank can come and take your home away from you as well, just to rub salt into the wound, which, by the way, we think should be illegal. Whereas with us, if you can't make your £1,000 payment, if you can only pay £800, no problem. You've not done anything wrong. That's absolutely fine because there's no debt. You can choose how much equity you want to purchase. And if you're down on your knees and you've lost your job and you can't even afford your £500 rent, you know you've got the security of the equity buffer. You've got the security of the roof over your head. And to put it into context, an average customer who has 10% equity in their home, if they lost their job on day one without ever having made a payment to us, that 10% equity buffer would last on average 2 to 4 years. So that's 2 to 4 years of security when you're going through the hardest time of your life. So instead of thinking, oh my God, how am I going to pay the mortgage? You know you've got the security of the roof over your head. This is the beauty of the Islamic etiquette. It creates ease in times of hardship, rather than coming and taking your home away from you in times of hardship. So you've got that security so that you can focus on what's important. Getting back on your feet, finding another job and starting to make your payments again. And I'll give you a real life example, by the way, a real customer of ours. I won't name names, but you probably won't name anyway, but self-employed taxi driver, right? So he works, he drives a taxi and that's how he earns his money. Now there was a period where he became unwell and he couldn't work for a while, right? What would he have had to do with the mortgage? He would have had to call the bank up and say, I'm really sorry, I can't work, I can't afford it, please have mercy. What did he do with Pfida? He went into his app, he reduced his payment to something he could still afford, and he sent us a message saying, just so you know, I'm unwell, can't work for a while, so I've reduced my payment, and when I'm working again, I'm going to increase my payments and catch up again. So when he was going through a hardship, he was able to continue in absolute dignity, even when going through the hardship, rather than having to call the bank and beg for mercy. And this is the beauty of the true Islamic partnership, that it creates ease in times of difficulty, and it protects both sides. It protects our customers in times of hardship, and it also protects us, because our customers have that equity buffer they can rely on in times of difficulty. So both sides of the equation are protected, right? I'll give you another example, actually, of when we were setting up. There was a customer doing a development deal, and we don't tend to do development finance, but we just did it one-off just to give it a go. And he was actually about to build a block of student flats. And this was back in November 2019. Who can tell me what happened in November 2019? COVID, right? So just as his contractors were about to start work, his contractors downed tools and stopped because COVID kicked in. If he had a finance with a bank, he would have lost that land, the bank would have fire-saled the land, he would have made a loss and the bank would have made a loss. With us, because there was no debt, he just serviced the rent. He carried on paying his rent month by month, which was an amount he could afford, for 18 months until lockdown ended. And then he got his contractors back on the site, they started work again, built his property, sold it, made several £1 million in profit. He made extra money and we made extra money. Both partners were protected, even in COVID. This is the beauty of the Islamic partnership. So that's the Pfida model in a nutshell. We also, as I mentioned, make it affordable by when we sell equity to you. What really distinguishes us from shared ownership providers, as I mentioned, they revalue the property when they sell equity to you. Pfida has a clear mission. I mentioned at the start, we put P first. P stands for people, right? Our mission is to put people first and bring Pfida to the people. That is our mission. Even if it makes our names sound weird, right? We put the P first. So we are on a mission to increase wealth and increase home ownership, particularly amongst Muslims, who are one of the most financially excluded segments of society. So we decided very early on, we will make our money from the rental income. And when we sell equity to our customers, we will sell it at the original cost. Remember when Sheikh Salman said, imagine if your landlord said, my property's worth £500,000, but I bought it 20 years ago for 100,000 and I'll sell it to you for 100,000. Remember he said that would be a dream come true? That's actually what we do. So we decided very early on, in line with our mission to increase wealth for Muslims, we will sell equity to our customers at the original cost, even if the property is going up in value. That's our gift to our customers. And we make our money off of the rental income, and this is sufficient for us. Alhamdulillah. So that's how we make it competitive, even against conventional mortgages. So you get all the benefits of a shared ownership product, the flexibility, the debt-free, the risk sharing, but you get the price point of a mortgage product. And as I said, in some cases it can be competitive even with a conventional mortgage, not every case, but it will definitely be competitive at least with an Islamic bank mortgage, and in many cases competitive with a conventional mortgage. And you can check our calculators online, inshallah. Right, just one or two more slides, then we're going to get to Q&A, inshallah. So I've talked about our app several times. Our app is something we're very proud of, and is something our customers invariably absolutely love as well. It's a web app, by the way, so it's not a native app, so you just log in via URL. So the way our app works is it empowers you to make basically self-service, right? Imagine ordering a taxi. It used to be that you call the taxi company, you pray that your taxi turns up on time, and then you have to have cash in your pocket to pay the taxi. Who likes doing that anymore? Or show of hands, who likes doing that? Who prefers using Uber? No one. Okay, fair enough. I think generally people prefer, in today's modern digital age, to order the taxi on their app, see where the taxi is, pay for it through the app, and get on with their busy lives. And that's what our app is designed to do as well. So through our app, first of all, you have a dashboard. So you can see all the metrics to do with your property. You can see how much equity you own, how much is left to purchase. You can see what your monthly payment breakdown is between rent and your target level of equity purchase. You can see your future payment projections. You can see how you're doing against your original projection, all of the metrics you might want. And then you can manage your agreement as well. So you can go into your settings, change your payments. You've been promoted. Remember the example I gave? You've been promoted. You want to start paying £1,200? Great. You can go into your app, type in 1,200, khalas, done. Start paying £1,200 from now. No problem at all. The reason we can do this is because there's no debt. So you can buy as much or as little equity as you like whenever you like. That's what the debt-free partnership model enables. You can also do something even more interesting, which is what we call what-if analysis. I've saved up £10,000, or my uncle passed away and left me £10,000. What if I buy £10,000 of equity this month? What does that look like? What does it do to my term? What does it do to my monthly payments? What does it do to my total cost? How much money do I save overall? Do I like this outcome? How about instead if I spread that 10,000 over the next 3 months? Which one do I like more? Which one saves me more money? Which one helps me achieve my goals? This one? Okay, great. Click and it's done. You can do it at 3 o'clock in the morning sitting on your couch. You don't have to call us. You don't have to email us. You don't have to speak to us. You don't even have to come into branch or apply for a brand new product because it's debt-free. You can just completely self-manage. And what we find is the majority of our customers, of course we're there if you want to speak to us, of course we are. But we find the majority of our customers in today's busy world want to just self-manage and get on with their busy lives. And that's exactly what the app facilitates. And it enables you to make those financially informed decisions because you can see the result of those changes before you make them, which no other provider does, right? If you've got a Barclays Bank mortgage and you want to start paying £1,200 per month, you have to go and apply for a brand new product. You have to go through the time, the cost, the headache, the commitment, and you don't even know if you're making a good decision because you don't know the impact until you've gone through the process and done it. And God forbid, if you then want to rewind the decision, you have to go through the process again. Whereas with us, you can just go into your app and make the changes anytime you like. And that's something we're very proud of, something which our customers absolutely love. And I think that is the last slide, Sheikh. Can you just check? Oh, no, just a very, very quick summary, just comparing the different products on the market. So with the Pfida product, it's a co-ownership structure similar to shared ownership products. There's no debt with our structure. So bank mortgages and Islamic bank mortgages, they are debt-based products. Our product is like a shared ownership product, it's a co-ownership. Our product actually ends up being quite affordable. Shared ownership products tend to be very expensive in the long run, and you need to have a long-term plan if you're going for a shared ownership product. Mortgage products tend to be more affordable, and that's because they are ultimately debt-based. Debt is generally the cheapest form of finance, but we're very proud that we can compete. Even though we're offering a shared ownership type product, we're very proud that we can compete even with a mortgage type product. With our product, you get to full ownership at term because we incentivize you to stick to your target payments. We incentivize you to get to your goal by giving you those rental discounts. Our product is very unique in that equity buffer mechanism. In times of difficulty, you can actually sell equity back, and that gives you the security of the roof over your head. You have enormous flexibility with the Pfida product. Bank mortgages, very little flexibility. And shared ownership, you've got a bit more flexibility, but the onus is on you to remember when you want to buy equity. With us, you can literally, from month to month, choose what you want to pay through the app. Sharia compliant, again, Islamic bank mortgages are also technically Sharia compliant. They're approved by reputable scholars. Shared ownership products are also Sharia compliant. You cannot fault them from a Sharia perspective. But I've got another line there, which is a bit blurry, apologies, called Maqasid al-Sharia, the higher principles of Sharia. Are Islamic bank mortgages achieving the higher principles of Sharia? And I would argue on this point, although they are Sharia compliant, I would argue they are not necessarily achieving the Maqasid al-Sharia, because the outcomes are actually the same as an interest-based mortgage. And with shared ownership products, again, the reason, this one's sort of 50-50. Some of them are actually very genuine. But the reason I put across here is because with many shared ownership products, actually the funding line in the background is just an interest-based loan from the bank, right? So you have to be comfortable with where they're getting the money from as well. And also, as I mentioned, some shared ownership providers have very, very harsh restrictions in their agreement that can really penalize you if you miss a payment. So you just need to be aware of that as well. The big drawback with Pfida to be aware of is that we're relatively small. We're not a big bank. We're not the size of the big. We're not a bank at all, actually. We're not the size of the big banks yet. We're on a journey. So that you can't just, with many of the other providers, you can walk in and say, I need a mortgage. You can get served today. With us, there is a waiting list. That's the key thing to be aware of. There are ways to get ahead in the waiting list. We've got a public waiting list. We've got a completely separate waiting list for people who open savings accounts with us. We offer savings accounts as well. They're investment accounts. Anyone who opens an investment savings account with us feeds into the system. They get into a separate waiting list, and you can actually buy a bit quicker. But even then, there is a waiting list. And you can check the FAQs on our website, which go through the estimated wait times based on different scenarios. But that's the key thing to be aware of with Pfida, where we're ultimately a community organization. We're not a bank. Banks have all the money. Banks actually can print money, right? Do you know this? When you put £100 in your bank account, the bank uses up to £99 of that to lend out on a mortgage. Now, your bank balance still says £100, right? But somebody else now also has £99 to buy a house with. How does that work? They've created £99 out of thin air. This is called fractional reserving. And this is what creates inflation. So the problem is banks can actually print money at will. They have a license to do this. The Bank of England on their website actually states this. Banks are allowed to print money at will, unrestricted. As a result, they have all the money. We don't do this. We are a community organization. We are 100% community funded. So we don't take bank loans in the background, lending lines. We are entirely based on the community coming together, pooling resources together through our investment accounts, and we use those pooled resources to support the entire community. The premise of our savings products is that we all support each other. We get out of the mentality of what's in it for me, how quickly can I be served, what can I get from this? We all need to get into an ummah mentality. How can we all support each other? How can we all pool our resources together as a community? And how can we all uplift each other together? And we've taken the first step by creating the product and by gifting all of the upside in the property to you. But for the Pfida model to work, it requires the whole community coming together. Otherwise, if it's just us doing the work and nobody else supporting, then it doesn't work. So it requires a community effort, inshallah. But it does mean that it requires patience as well. So if you are interested in the Pfida model, it might not be right for everyone. If you can't wait, and there are very valid reasons why you might not be able to wait, then it might not be the right product for you. But if you can wait, we get customers coming to us saying, I've been renting for 35 years because I didn't feel comfortable with any other product. And then I say, okay, you're going to need to wait 1 to 2 years to buy a home with us. They say, I can't wait that long, brother. And I say, brother, you've been renting 35 years, alhamdulillah. So it requires a bit of patience. But that's the key drawback with the Pfida product. Okay, I think that's the last slide. That is the last slide. There is a QR code there. If you are interested in our services, you can scan that. We've got a free, I think it's a 26-page halal home buying guide. So if you scan that, you can get a free halal home buying guide as well. And you can also find out more about our products and services if it's of interest to you. But that is the presentation. And really now I invite you to ask any questions that you may have. And we're here for as long as you need us, inshallah. Yes, Uncle.
MashaAllah, if you have explained at least I'm signed on to it. The main thing that you said, that there's a waiting list, and we tried a couple of years before and things get onto it because I want the house today, but it's 5 years waiting list. Is it possible to talk about a bit of investment so we can put the money in so that more people can actually utilize that?
Yeah, so that's how our
it's basically so we know that our money and how Sharia compliant are your products basically for investing.
Yeah, so that's actually exactly how our model works. It works on the community pooling funds together and everybody benefiting together and uplifting each other. So our savings accounts, we're not a bank. It's important to understand they're not deposit accounts like you get with a bank. They're investments. And investments aren't right for everybody, right? So it's very important. Actually, when you go to the investments part of our website, it will ask you, what kind of investor are you? And you have to fall into a particular category for our products to be right for you. And if you don't fall into one of those categories, then it's important that you get financial advice before proceeding. And we facilitate that. We can set you up with a financial advisor. We actually have a promotion where we pay for that financial advisor as well, so you get a free session. Then the financial advisor will assess you, make sure you understand the risks of investing, and then decide whether it's right for you or not. And if so, then they'll certify you, and then you can go ahead and proceed, inshallah. But it's very important from a regulatory perspective. We have to be very careful not to invite people to invest who it might not be right for, right? The investment is basically in property investment. So if you are comfortable with property investment and you're well versed with property investment, then it might be something to consider. But we have different types of savings accounts offering different returns. And the whole point is that those savings are pooled together to help Muslims into halal home ownership. So as well as getting a halal return, your money is being used to help people avoid riba. And we all know the severity of riba. We know that Allah subhanahu wa ta'ala in the Quran mentions that those who deal in riba are waging war against Allah and His Rasul. There are some narrations saying that on the Day of Judgment, you will be given a sword and told, now go wage your war against Allah and His Rasul. Astaghfirullah, just imagine being told, go wage your war against Allah and His Rasul. And there are some narrations comparing riba to fornicating with one's own mother as well. Na'udhu billah. So we know the severity of dealing in riba. So imagine the reward of helping just one family to avoid riba. Or imagine the reward of helping multiple families avoid riba. Imagine the reward of helping multiple families for a long, long time to avoid riba. My brothers, if we could see that reward, I believe we would all run towards it, right? And this is the whole purpose of Pfida. This is why we are called Pfida, is to create Pfida for all of us together, inshallah. We've done the hard work setting up the product. We've given up our lucrative city roles to create this. And by the way, for the first 5 years, we didn't take a salary, right? When I had that conversation with my wife saying, we're used to a good life, but you're going to have to be patient because it's going to get tough, I meant exactly that. For the first 5 years, we did this completely fi sabilillah because we are on a mission to just be able to say, Ya Rab, we tried. But we cannot succeed if you guys don't support us. The only way for Pfida to succeed, for us to create a system outside of the banking system, which doesn't serve us very well, is if we all come together to support this together. We must, brothers, get out of the framework of saying, me. How can I get served the quickest? How can I get a house the quickest? How can I get the cheapest rate? I don't care about anybody else. We are one ummah. When one part of the ummah is suffering, all of us suffer. We all know what our brothers and sisters in Palestine are going through at the moment. We all feel that pain deeply. We must also feel the pain of Muslim families who are stuck renting, unable to buy a home, and Muslim families who are stuck in riba because they had no other option. We mustn't judge these families, right? If you're a family who has 7 kids and you're stuck in a 2-bedroom flat, where your baligh children, male and female, are sharing a room together, this is a moment of desperation. So we mustn't judge families who have entered into riba, and instead we must sympathize with them and say, how can we help each other get out of riba? And this is what the Pfida system is here to produce, inshallah. We've taken the first step. We need you guys to take the next steps with us, inshallah. Yes.
This is on the regulated by FCA. Another question is that, let's say if I am, I've been picked up, wait list is over, how long will the process take? Because that's another pain point with Islamic banks as well.
Great question.
And after sales service, sort of, how's your after sales service? Like, once everything is done, is it app-based? Because not everyone is going to be comfortable using that. That's it.
Great question. Okay, it's Pfida regulated. So on the home buying side, just like shared ownership providers, because there's no debt, there's no lending, it doesn't require a regulatory license. Right? Just like landlords don't need an FCA license, similarly, we don't need a license. We went through a 2-year process with the FCA. The FCA reviewed everything with a fine-tooth comb, and roughly once a year, they review everything again. But the FCA themselves have given it to us in writing, because you are not lending, you're not creating debt, you don't require a license for this. On the savings and investment side, there is a regulatory implication. So there we work with an IFA, who is financially regulated, who ensures that we are sticking within all of the regulations, and we use the IFA's cover. What we're doing now is looking at potentially getting our own direct cover. But in the meantime, we're relying on an IFA to make sure we are adhering to all of the regulations. But the FCA, as I said, pretty much once a year review our entire business model end to end. You asked a couple of other things, sorry.
Yes. So if my waiting list is over today, what's your process?
How long does it take? Okay, one of the biggest pain points up until now that our customers have had is how long it takes, the processing time. So your turns come up until recently. So a conventional mortgage takes 2 to 4 months. Up until recently, our average time was 6 months, way too long. And it was a cause of great stress and anxiety for our customers and for us. All of my grey hairs are due to that, basically, the stress of every single property completion, because it just took far too long. And we used to get threats from sellers saying, I'm going to pull out, it's taking too long. We have now just launched a new product. The reason it used to take so long, by the way, was because of the structuring. With a conventional mortgage, you have one solicitor who represents both you and the bank and works for both of you. With our structure previously, we had 2 solicitors, one representing you, one representing us. And that meant that things took twice as long because you had 2 sets of solicitors. We've now just restructured it so that we're down to 1 solicitor now. And as a result, we now expect we're inshallah going to complete on the first property under the new structure next week, inshallah. But that's going to be the proof in the pudding. We now expect to be able to, it won't be quite as quick as a conventional mortgage, because a conventional mortgage doesn't care about the property. We do. So we get the property surveyed and we understand every nook and cranny, and we make sure it's a property you want to raise your family in. We make sure it's a property we want to invest in, right? Banks don't do that. So that takes a little bit of extra time. But whereas a conventional mortgage takes 2 to 4 months, we expect now under the new structuring to take 4 to 5 months, inshallah. So a little bit longer, but nowhere near as long as it used to take, inshallah. Much more reasonable time frame, inshallah. And then in terms of aftercare, you mentioned. So we find most of our customers do want to self-manage through the app, but we're also there. We have live chat, we do callbacks, we have email. So we have a full customer service team. If you need anything at all, we're on the end of any of those facilities, inshallah.
Is this only for the people buying their new homes or people who are already in that dirt of river? Anything for them? Can they come? Is there a process?
So technically, we can do refinance. We do buy-to-let as well, by the way. For buy-to-let, there's no issue whatsoever. For the home provision scheme, where you're living in the property, right now there's a stamp duty implication. So if you refinance to us, you'll pay stamp duty again. and we don't recommend it. It just ends up being very expensive. So it works better for new properties at the moment rather than refinancing. We're trying to find a solution for the stamp duty. It's, the way the stamp duty law works, if you're a bank, you get an exemption from paying stamp duty again. But because we're not a bank, we don't fall into that exemption. So it's a very unfair playing field, unfortunately. Because we're not a bank, we have, so banks have all the money, and the stamp duty laws dictate that because they've got all the money, they don't have to pay as much tax. But we're smaller and have less money, so we have to pay more tax, unfortunately. So it's just the problem is the tax laws never envisioned this kind of product. So now there's a long process of lobbying and trying to get those laws changed. But at the moment, it is an unfair playing field, unfortunately.
How do you work out how much rent to charge?
Great question. Okay, so when assessing the rent, what we'll do is we'll look at your property, we'll look at the local property market, and we'll come up with a reasonable range for rent in that area. We'll come up with a low estimate, medium estimate, and a high estimate. And our mission is to try and come within that range. We then have to overlay commercial business factors, right? So we look at what we need to actually charge to make money as a business, right? Because there's no point us charging something where we're making a loss. So we have to actually make money. So in an ideal transaction, the amount we need to charge will fit neatly into that rental range, and we're both happy. In some areas, the amount we need to charge may actually be at the lower end of the rental range, and you may get a great deal. And we've had transactions like that where we've been able to charge bottom of the range. In some areas, it may be middle of the range. In some areas, it may be top of the range. And there may be some areas where we have to say, look, for this transaction to make sense for us, we would actually have to charge you slightly higher than the market rent. Are you still comfortable paying that? And then it's up to you if you're comfortable paying that or not. So we try and overlay what we need to charge with the reasonable rental range for the market.
So you do rental agreement?
Yeah, so Sheikh, do you want to talk about the co-ownership structure?
Assalamu alaikum. So our product is based on co-ownership, and that's actually something that was inspired by Scotland, because when we were structuring a product for Scotland, we found out that in Scotland there's a different set of laws to England. It's actually a different legal system. And in Scotland, there isn't a concept of a long lease. So any tenant can, I think, technically get out of a rental contract or a lease with 30 days notice or something like that. Okay. And so the traditional model where we would give you a long lease and a rental contract, which enables you to have security of tenure and live in the property, doesn't really work because it doesn't give the financier security that you'd stay there for that period of time. And so what we've done now is we've got a co-ownership where you own part of the property, we own part of the property, and then you have an occupation agreement, which as an owner, you have the ability to now live in that property, and then you pay us an occupation charge for the period of time that you're living in the property on our share of the property. Does that make sense? Yep. So there isn't a rental contract, it's not required. There's an occupation agreement.
So what is the difference between your agreement and Islamic finance and Islamic banking agreement?
Okay, so
and your agreement, what is the difference between?
All right, let me actually open that question to the floor, because I did touch upon this when I presented earlier. What's the key difference? What would you say is the one key difference between the way we do it and the way Islamic banks do it? Obligation to buy. So in the Islamic banking model, there's an obligation on the customer to buy the bank's share for a fixed amount of money, which is the amount of money that the bank put into the contract in the first place. And that's what creates the debt. We don't have that obligation. So our customers have the option, the freedom to buy our share, but not the obligation. And therefore, there isn't a contract for them to buy our share. In each month, they will make an offer and we will accept. The only contract that we sign on day one at the beginning is the occupation contract.
So in Islamic finance or Islamic fiqh, you can stipulate any condition. It is allowed under the partnership, Islamic finance. You can stipulate, for example, me and you partner, and I can say, okay, we do business, but only in Scotland we do not do business in England. We can stipulate. If I, as a partner, say you have to buy my share, in Islamic fiqh it is not any. Islam say okay, it is possible.
That's a very good point. So up to that point, that's well and good. And the way I presented it, if you remember, I said when the bank enters into the co-ownership with you, you have a musharaka. That's right. Well, you have a sharika at the beginning, and then when the bank sells you their share,
Yes.
there's no problem with that because it's open. It's freedom of contract. Any partner can offer to sell their share to the other partner, and they can agree to buy, and they can give them credit terms. You can say, okay, you can pay in installments over time. There's no problem with that. The issue then arises in the third contract. The second contract of sale is the bay'atayn fi bay'ah. The second bay'ah is that after selling you their share, they then say, until you've paid me those installments, you have to pay me rent on my share. So it's the addition of that third contract that creates a situation where the customer is in debt to the bank, and the customer has to, on top of that, pay rent to the bank.
I'm sorry, but the same as you say occupation, you charge occupation, and here because you are living in my property, so I am charging rent on that.
That's if you look at the rent separately. So if you've got
This is not very a transaction within transaction between, because this is the shirkat al-mutanaqisa, diminishing musharaka. There is no difference between in Pfida and Islamic finance agreement.
Let me explain the key difference. In our contract, there's no obligation on the customer. So we don't sell our share to the customer on day one. There's no obligation on them to pay us installments and credit. There's a key factual difference.
I'm sorry to interrupt.
That's right.
But Sharia allows two partners can stipulate, can make conditions. Which is Sharia allows.
In isolation, yes.
Yes.
In isolation, yes. So let me give you an example. The Sharia allows me to sell you my phone on credit for £110. Okay? That contract on its own is allowed. The Sharia also allows you to sell me that phone on cash, and for me to give you £100 cash. But when you combine the two, so that the second is conditional upon the first, it becomes bay'ina.
No, bay'ina is very different. Shirkat al-mutanaqisa means that you have to, that we are partner, but you will buy my shares, okay, and our partnership will become diminishing. It is called diminishing musharaka. Shirkat al-mutanaqisa means that you will buy my shares. There are a lot of the different types of shirka, shirkat al-inan, shirkat al-wujud, shirkat al-mufawada, and one of them is shirkat al-mutanaqisa. Then, okay, we are partner, but you will buy my share. This is called shirkat al-mutanaqisa.
Yeah. So in a pure sharika mutanaqisa,
Yes.
there is ijab and qabul on a monthly basis or on a 6 monthly basis. So in each month, the customer will come and say, "I offer to buy your share," and the owner will say, "I will accept." All right. But if it's obligated on day one, what you have is a combination of bay'atayn. This is why many scholars.
In shirkat al-mutanaqisa, there is no condition that I come to you monthly basis and say I give offer and you accept. No. On the first basis, when we are doing shirka, and we say it is shirka al-mutanaqisa,
So in that practice, this is why many scholars consider this to be controversial.
no,
Because
shirka al-mutanaqisa, I'm sorry, I want to discuss this thing.
that's fine. Look, let's take this offline because this is a technical fiqh issue.
Yeah,
There are scholars who permit it, and the scholars who permit it, when we discuss it with them, they agree this is not ideal. The practice of it is not ideal. The many scholars who are on the Sharia boards of the Islamic banks, when we sit down with them, we have the fiqh discussion, they will openly say this is not ideal. We have given this as a rukhsa to the community to enable the Islamic financial system to grow roots in this country.
Shirka al-mutanaqisa, it is a very common practice in Islam.
It is. There are many common practices like this. This bay'ina is very common practice as well. Like in Malaysia, it was very common practice until 10, 15 years ago. And now what they've done is they've introduced this other brokerage arrangement where the bay'ina is done through what they call tawarruq, right? So it's still a controversial practice. It's done, And we're not here to fault it or to put it down. Yeah, let's take this offline. Let's take this offline, because this is a debate that's raging in the Islamic finance. We're not going to resolve it in this masjid here today. It's a discussion to be had. We can, it's a scholarly discussion. We can have that offline. Okay. Yes.
What about the exemptions we are given over here? Like for this, Islamic mortgage, they say this is scholars, they have given us an exemption for that. These exemptions are okay, they are okay in our, like in as we are Muslims living in foreign societies, But why they are not implementing it in the way that where the Muslim people are living actually, and they should be living into riba-free, environments? Why they are polluting their own systems? Still, they have full power under control. Why they not coming out of it? Actually, I'm seriously confused.
So
okay, these exemptions are for us, but for living people in Pakistan.
That's a really good question. Raza and I last week were in Malaysia, where in Malaysia there's a lot of government support. There's a lot of support within the central bank for Islamic financial practices. But at the same time, there's a overwhelming financial system, a financial hegemony that's based on Western ribawi systems. So 60% of the banking system in Malaysia is still non-Islamic. You'll be surprised to find out that even in Saudi Arabia, a lot of the financial system is based on interest-based banking. When I was working in the law firm about 15 years ago, we were doing a financing of a university campus in Saudi Arabia. And the local lawyers, the Saudi lawyers that we were dealing with, they said, "Oh, it's great that you're doing this on an Islamic basis. Many of the hotels and the buildings in Mecca and Medina are financed with just normal interest-based loans." I was shocked. We go to Hajj and Umrah and Ziyarah, but the hotels we are staying in the vicinity of the Haram were financed by interest-based loans. It's shocking. And so this is a crisis, a calamity that's affecting the whole Muslim world. And as we know, Islamic governments in Muslim countries, they will apply Sharia in matters of inheritance, in family law, in other aspects of the law. But actually, in say criminal law or in financial law, it's not Islamic. Even in countries where the constitution, like Pakistan, where the constitution is an Islamic constitution, it starts with, this is an Islamic state, even in those countries, okay? So, there's a sort of wider discussion to be had in the Muslim world as a whole about what is our strategy to draw closer to the Sharia of Allah. That's a wider discussion. That's something that, again, we're not going to solve in this masjid here today. But what we can do at a micro level as a community here is, and I think this is really important. So this discussion about what is Sharia compliant? Yes, the Islamic banking model ticks the boxes and is Sharia compliant. It has a fatwa. Scholars are passing it as Sharia compliant. The same scholars, they are calling for a move towards more authenticity. So not just Sharia compliant, but be Sharia based. Can you do a Sharika mutanaqisa in a way that there isn't debt? Because in the Islamic banking model, even though it may fulfill certain conditions of Sharia compliance, it's still a debt-based contract. The customer is still in debt to the bank. That's a factual statement. That's not something that we will dispute about. If you look at the contract, I'm a lawyer. If you're a mechanic, you can open the bonnet of a car and you can see what's going on underneath, because that's what you do. You fix cars. What if you were someone who actually makes cars? You'd be even better at knowing what the contract or the mechanics is doing. That's my experience. We actually made these contracts. So some of these banks that you hear about, we made their contracts. So we know very well that those are debt-based contracts. Even though it's called a sharika or a musharaka, it's a debt-based contract. We want to move away from debt-based contracts to true partnership-based contracts where there is true risk sharing. Okay, so without going into the nitty-gritty of is it Sharia compliant, is it not? What I would say at a high level, we will all agree unanimously that it's better to move towards true sharika where there is risk sharing, according to the hadith of Ar-Rasul ﷺ, where he said, Al-Kharaju bil-Daman. If we can apply that, that is the best. I think we'll agree unanimously that is the best. We had a brother there, and then we'll come over here.
Where do you guys get the money to finance buying for?
Where do we get the money to finance? I'm going to let Raza answer that. He's the numbers person. I do the words.
Yeah, so as I mentioned earlier, we also have savings accounts. We're not a bank, so they're not deposit accounts, they are investment accounts. And people place money with us, that money is used to buy homes, and it generates a return from the rental income, and that's how we give a return. So we are entirely community funded. As the community comes together and pools funds together through Pfida, that pool of funds is what we then use to fund more and more homes, inshallah. So we have some people opening savings accounts with us because they're interested in buying a home. We have some people opening savings accounts with us because they just want to save their money in a place that's halal, giving a halal return and giving a sadaqah jariyah return, helping Muslims to avoid debt and riba, right? So as more and more people from the Muslim community pool funds together through us, inshallah, we can grow and serve more and more people.
What sort of returns do you get from these products?
So I'm going to have to cop out here for regulatory reasons. I'm actually not allowed to, in a public forum, advertise the returns. But if you want to find out, you can just go on our website. You just have to do your investor declaration, and then you can go and see the returns on there. But I'll get in trouble if I advertise the returns here in a public forum. That's the regulatory rules. We're not allowed to do financial promotions except to people who we know qualify for those investments. So we just have to tread very, very carefully, or we'll get in trouble with the regulator. So I know it sounds like a cop-out, but I don't want to get in trouble with the regulator.
It's true.
Yeah.
Do you actually invest in SIPs and things like that?
No. So the money that people invest with us, so when you put money in a bank account,
No, the Sharia compliance SIPs.
Yeah.
You don't.
no, we only use the money for one purpose only, which is to fund homes in a halal, debt-free way. Interesting, when you put your money in a bank account, the bank actually has a license to do whatever they want with your money, right? So you actually have no idea what they're using your money for. Banks can use your money to take excessive risk, and if that risk pays off, they take all of the return, and you get a tiny sliver of that in interest. And if the risk doesn't pay off, then they rely on the taxpayer to bail them out, right? This is how the banking system works. It's remarkable, right? And also, actually, think about it this way. And I'm not saying down with banks, by the way. We need banks for day-to-day banking activity, but we need to also, as a community, reduce our over-reliance on banks. Because when we put money in a bank account, we are signing a contract saying that I permit you, the bank, to use my money, not your money, my money, to lend with interest. That's actually what we're permitting them to do, right? When we put our money in call it a conventional bank. When we put our money, especially in a conventional bank, we're signing a contract saying, I permit you to use my money to lend with interest. And we should all be very uncomfortable with that. But even with an Islamic bank, because every single bank does this, prints money. So even with an Islamic bank, when we put our money in an Islamic bank account, we're saying, I permit you to use my money to print more money. And by printing more money, you create inflation. And by creating inflation, you price me out of the very home that I want to buy, right? So I'm not saying down with banks. We need banks for day-to-day activity. But as a community...
I'm not talking putting the money in the bank. They put into, Islamic products, basically. The SIPs are not left in the banks.
Yeah. I'm not talking about SIPs. I'm talking about, as a community, we have a tendency to just leave all of our money in a bank account. And that's what we need to get much better at, because it's the very worst thing we can do with our money, leaving all our money in a bank account. It actually prices us out of the very homes we want to buy. We need to get much better at investing, being comfortable with investing. It's now easier than ever to invest in a halal way. There are so many platforms available for Muslims to invest, earn a halal return, beat inflation, and prevent that bank printing more money and widening the rich-poor divide. We all need to educate ourselves on this, inshallah. Yes, ma'am.
Someone can't beat the rent. You mentioned that you buy back the option regarding what do you buy that at the same price, selling price?
Good question. So if someone needs to rely on their equity buffer, you mean, if they need to sell equity back to us? So it's two options. Because we always offer to sell equity at the original price, one option is we buy it back from you at the same price, and then we sell it back to you at the same price. But what if the property market has declined and the property is actually worth less? So the other option is we could buy it back from you at the depressed market price, and then when we sell that equity back to you, we sell it back to you at the same depressed price. The point is, it doesn't matter either way, because our selling price is our buying price. So whatever we buy it at, that's the price we offer to sell it back to you at, because our mission is to give you the upside. We make our money off the rental income. That's our business model. Yes, please.
So see if we get into a contract with a house, right, and say due to family growing or reallocation of the job, we make it into another property.
Great.
How would Pfida support? Can we support that transaction?
Absolutely. Yeah. So so I mentioned when you're buying equity from us, we sell it to you at the original cost, right? Now, the reason we do that is to keep it affordable, because otherwise it would become more and more unaffordable over time as the property increases in value. But if you decide to sell the property, now you're crystallizing a profit, right? And as your partner, we are your partner, we've taken risk in that property with you. It's fair that we take our share of upside in that situation. But if you're selling and moving on, then it's fair. We take our share, you take your share. That's fair, that's a partnership. But if you're selling because of your example, your family's growing, you need to upsize. We want to facilitate that. That's part of our mission. So in that situation, we try and be as generous as we can. We say, right, you take your share. We'll only take half of our share of upside and we'll gift half of our share to you. So we try and be as generous as we can to our customers in every situation, whilst also trying to be fair to ourselves, because we're genuinely sharing in the partnership risk of the property. And this is one of the differences with Islamic bank products. With Islamic bank products, they won't share in the downside, and we actually share in the downside risk as partners.
Did you say earlier you had a product for buy-to-let as well?
We do, yes.
So is that model any different to the one that you just explained?
The mechanics are identical.
Okay.
The legal structuring is very slightly different, but from a day-to-day user experience, exactly the same. The only reason the legal structuring is slightly different is because with the buy-to-let product, it's not you living in the property, it's your tenant living in the property, and we have no relationship with them. So we just have to structure around that to protect ourselves against a tenant who we have no dealings with. But apart from that, all the mechanics, everything works exactly the same.
Just something like if the product looks like more near to halal, that contract is also halal.
I don't understand the question. How can the product be halal if the contract's not halal?
No. They are two separate things actually. But, in my mind, they are two separate things. Like if I want to buy the property from you, that we're putting there's a compulsion and there is no obligation there. These kind of things are mentioned in the contract that you're not going to oblige us to buy this.
Okay, so
You got my point.
I understand.
What I'm trying to say.
I understand. So
One
with-
is when we're getting into the contract, the transaction thing which is explained in the contract,
yes.
it should be like as harmless.
So it's the other way around. So with an Islamic bank mortgage, you will have one contract for the rent, right? One lease contract saying you must pay rent every single month. You will also have another contract. It may be within the same contract, but it's a second contract saying, as well as paying your rent every month, you must also buy equity every month, right? So you've got two contracts. With us, you've got one contract. You've got one contract saying you must pay your rent every month, and that's it. So you don't have a second contract saying you must also buy equity every month. Do you see the difference? So it's the absence of the contract requiring you to buy equity every month, which means you are not obliged, right? We'll take him and then you.
And it's a follow-up of that one as well. So if I don't have a contract with you to buy equity every month, and you earlier mentioned, as Sheikh Salman mentioned, that I can come every month to you to buy equity. How does that work? What are the mechanics of that? And how?
It's simple offer and acceptance. So imagine the simplest way to think of it. Imagine you're renting a property from a landlord, right? When you're renting from a landlord, your only obligation is to pay your rent and take reasonable care of the property. So as long as you're paying your rent and taking care of your property, that is your contract fulfilled. Now, when you are renting from a landlord, you can go to your landlord anytime and say, Mr. Landlord, I would like to buy your property from you, correct? And the landlord can say, sure, you can buy my property, it's worth X amount, pay me X and you can buy it, correct? But that is completely separate offer and acceptance. You don't have to do that. There is nothing in your contract stating you must do that. It's entirely up to you if you wish to go and do that. And it's entirely up to the landlord if they wish to accept, right? So similarly, every month when you want to buy equity from us, you offer, you don't have to offer if you don't want to, and we accept. And technically we don't have to accept if we don't want to. But our policy is that we will always accept, because that's our mission. Our mission is to get you to full home ownership. So our policy is whenever you want to buy from us, we will sell to you. But technically, you don't have to offer, and technically, we don't have to accept.
Two parts to that. One is, for example, next month I come in and I offer 10% of the equity from you. What does the impact of that is on the rent for the following months? Plus, is there any legal complicated procedure involved in that every monthly, for example, buy equity?
I'm really glad you asked that question, because the answer is it's dead simple and it's all facilitated through the app. So when you want to buy additional equity, the only thing, so we don't have early or late repayment penalties because there's no debt, right? But the only thing is, if you want to buy a very large amount of equity, we might just require a notice period, because if you're paying a very large amount of equity in, we need to find another transaction to put that money into. Otherwise, it becomes expensive for us having idle capital sitting around. So we might just require a notice period. But if you want to buy equity, you can literally go into the app, say, I want to buy £10,000 of equity this month, click, and it's done. And the app will, before you commit it, you can see the impact. So you can see how much it will reduce your rent by, because our ownership reduces, so your rent reduces. So you can see how much it will reduce your rent by, how much you're going to save, what it will do to your lifetime cost. All of that you can see in the app, right? And then if you like the outcome, you can say, okay, let's go with it. Click and it's done, right? And the app will do all of that for you. There's no additional contracts to sign, nothing like that. You just do it all through the app. Very, very simple and easy. So we've created the most flexible product on the market. Ours is the only product where literally every month you can choose what you want to pay. No other product allows this.
Apologies for that. But it's a question another brother asked about the investment. We share the risk of the ownership. How is your investor protected, whether it's a saving account or investment account, with the risk that you take in investing there?
Okay, so what was the rule Sheikh Salman mentioned? For you to be eligible to take a return, what must you be willing to take? Risk. That's the definition of investment, right? You have to be willing to take risk. So when you invest in our savings accounts, you are investing into a property portfolio. Now, when we invest in property, we don't tend to think too much about risk, right? We think it's quote unquote safe as houses, bricks and mortar. Nothing's going to happen to this property. But properties, just like any other investment, carry risk. They're low risk, but they still carry risk. What's the risk you take when you buy a property? If you have £100,000 and you buy a property with it, if that property is blown away by a hurricane and the insurance fails, you've lost your £100,000. We don't often hear of properties being destroyed. We don't often hear of insurance failing, but it can happen. It's a low probability, but it can happen. That's the risk you take when you invest in property. Now, with our savings products, it's the exact same thing. Your money's going into property. It's low risk, but that doesn't mean it's no risk, right? Now, instead of your £100,000 going into one property, it's going into our entire portfolio of properties. So you get what's called diversification benefit. Instead of having all your eggs in one basket, your eggs are spread across all of our baskets. So that means, in the example I gave where the hurricane blows your property into the sea, you've lost your 100,000. Here, that same 100,000 gets spread across all of our properties. So even if one of those properties is destroyed and the insurance on it fails, yes, there will be a loss. But if that property is worth 1% of the portfolio, you'll only make a 1% loss instead of losing your £100,000. And that will net off against the returns you're receiving again as well, right? So investors we can't use the word protected because there is risk. That's what you have to understand when investing. That's why it's very important that before anyone invests with us, if they aren't familiar with investing, they have to get financial advice and make sure it's right for them. These are the regulatory hurdles we have to make sure we're adhering to. But it's a low risk type of investment. Yes, Fahd.
So if you invest and then decide 6 months later you need that for whatever, you can withdraw that investment like that?
Great question. Okay, so with a bank account, when you put your money in, what are you doing when you put your money in a bank account? What's the contract between you and the bank?
You take out every time.
It's actually a loan, right? Why do banks pay interest on bank accounts? Because you're actually lending them money. So when you're lending them money, you have what's called a call on that money. You can require that money back on demand because you've loaned it to them, right? Just like when a bank lends on a mortgage, they have a clause saying we can require this money back on demand. All £475,372, anytime we want, we can require you to pay that back straight away because it's a loan, right? So when you put your money in a bank account, you're lending money to them, you can require it back on demand. When you're investing in a property, if you buy a house and you need your cash back, can you require that cash back on demand? No, you have to sell the property first, right? So with us, when you invest with us, you have to understand there's a liquidity, a timing element to it. So if you need the money back, what we recommend is giving us minimum 3 months notice. We use that period of time to either raise new money or wait for customers to buy equity in their homes and release equity, and then we use that to pay your money back to you. And alhamdulillah, we've always returned money on time, but you have to understand there's a risk it could take longer. That's the risk of investing. This is why it's very important. Investing isn't right for everybody. Before considering investing, you have to make sure you understand. On our website, we've got a whole page dedicated to risk. These are the risks you have to be comfortable with before investing. Even though it's a low risk investment, there are a whole range of risks you need to be aware of.
What's the reaction of the company
So-
goes bust, basically, you know, is that FCA,
If we go bust,
it's the FCA,
okay, so with a bank account, if the bank goes bust, you're exposed to two types of risk with a bank account. One is timing risk. So the first £85,000 is protected by the Financial Services Compensation Scheme. So if the bank goes bust, you can apply to the FSCS. It might take 12 to 18 months to get your money back, but you will get it back. So that's subject to timing risk. Above £85,000, you're subject to credit risk. If the bank goes bust, you may lose that money, right? Timing risk plus credit risk. With our structure, there's actually no credit risk because the way our investment products work, you actually become a shareholder in the company that owns the underlying properties. So you have direct ownership. Pfida is just managing that company for you like an accountant. So even if anything happened to Pfida, if you've got an accountant managing your company, if your accountant disappears, you don't lose anything, you find another accountant, right? Your company, your assets, still yours. So with Pfida, there's no credit risk, but it's timing risk on the whole amount. If you need your money back, it could take longer to get it back. That's the risk you need to be comfortable with. Yeah. And there's also some underlying asset risk, right? As I mentioned, if a property is destroyed and the insurance fails, there can be a loss. And generally, for a small loss, it will net off against the returns. But if there's catastrophic losses in the portfolio, lots of properties are being destroyed. Maybe maybe a hurricane hits multiple parts of the country at the same time. I don't know, something like that. Catastrophic losses, then it can result in larger losses. But generally, the main risk to be aware of is timing risk.
What's the minimum amount for the investment?
£100.
Any indication of the waiting times at the moment for
It varies. So again, you can see on our website, there's what we call the public waiting list. Anyone can join the public waiting list. It's very, very long, right? There's, mashallah, you can see our product is quite unique. As a result, there's a lot of demand for our product. So there's a public waiting list. There's a separate waiting list for people who are opening investment accounts with us. And on our FAQ section, you have to do your investor declaration first. That's why I can't give specifics. And we're kind of handcuffed by what we can and can't say in a public environment. But if you do your investor declaration, you can go into the FAQ section and it will give you a table showing estimated wait times based on two things. One is how much you have available for your down payment. And two is how much funding you need. So it's a function of both things. But you can just go in the FAQ section, inshallah, Pfida.com. That's the public waiting list. Public waiting list is extremely long. But the reason being, we're prioritizing people who are feeding into the system. So if someone just wants to have a me mentality, just join the public waiting list, not willing to help anyone else, then that's going to take longer. If everyone has a me mentality, it's going to take longer. But if everyone has a ummah mentality, let's all support each other, that's how we grow quicker, that's how we help everyone quicker, right? So that's why we're prioritizing people who feed into the system. So we have a separate waiting list for people who open savings accounts and feed into the system. But again, I have to be very careful. I can't say too much in a public environment or I can get into trouble.
Any specific questions can be answered while...
In private, if you come up to me and speak in private, I can answer all the questions you like. But in a public forum, I have to just be very careful.
Or afterwards through the chat or...
100%, yeah. The best thing is if you want to find out more, go onto our website. If you create an account, it will ask you to do your investor declaration. And it will ask you, what kind of investor are you? Are you high net worth? No. Are you sophisticated? You're used to investing? Yes. Okay, great. No, I've never invested before. Okay, you need to get financial advice. And then what we'll do is we'll send you details of a financial advisor. It's the financial advisor I mentioned earlier who we work with. And we'll give you a free session with them where they will walk you through the risks and features. And then they will assess whether this is right for you. And if they think it's suitable for you, then they'll certify you as well. Right now, we've got a promotion where we'll pay for that session, inshallah. Yeah?
Is that with a machine or is it with a human?
No, it's with a human being. It's a real person. Yes, brother.
Can I just go back to the property situation?
Sure.
So we talked about the legal charge, first charge at the moment in Pakistan. Can you just summarize again what you said about the charges, the legal charges would be with yourself, with it being this type of property?
It's probably one for Sheikh Salman. I think the brother wants to know about the legal structure.
Sorry, if you could ask your question again, please.
So we talk about the legal charge. So normally the bank will have the first charge.
Right.
So in this structure, how would that work?
Right. Okay. So here, what we have is a co-ownership, and at the beginning, we will usually have the larger share. So, simple example: suppose 100k property, you put in 20k, we'll put in 80k. We'll have the larger share. So what we'll do is we will take a legal charge over your share of the property, just to secure our interest. So that's part of the contractual framework. But that doesn't secure a debt obligation. Usually, a legal charge, a bank will take a charge over your property to secure the debt that you owe them. So the key distinction I want to make here, because here you don't owe us any debt, it only secures the rental payments.
So how is that property logged in the title?
Oh, in the title, so in land registry, I think here it's called something slightly different. I think it's called Scottish Registers or something like that. Sorry? Saysian Register, something like that, yeah. So you have a different register.
It's old, but yes, land registry is the same.
Oh, it's the same now?
Yeah.
Right, okay. So in land registry, the legal and beneficial title will be jointly held. So your name will be registered with the land registry alongside ours. Yes.
And probably this one maybe goes back to better. Just going back to what you were saying about the shared part of it, where someone has, let's say, for example, some situation, they can't afford the rent payments, so they want to pay less. How would that work for how long? So if there's a 30-year term, someone comes to hardship, so can no longer afford £800, or maybe 500, has 200. How long does that go on until Pfida says, right, can't do this anymore?
Sure. So that's a really good question. Now, if somebody says, I'm not going to buy equity this month, I'm just going to pay the rental element, then that's fine. They don't need our permission to do that. They can do that on their app. They can self-serve that. But if they can't afford their rent in that month, so they can't afford the full rent, and they want to pay less rent, then they would have to contact us. And we've had a situation like that where, actually, we had another situation where somebody wanted to remember what it was? They wanted to go on holiday, right? So they wanted to not.
They wanted to use the equity buffer.
Yeah. So they wanted to not pay rent at all. They wanted a payment break, but they wanted to actually sell back some of their equity to us in order to effectively release some equity to cover their rent with their equity in order to go on holiday. And we said, no, that the equity buffer isn't there to facilitate luxury. It's there to really be a backstop in an emergency situation to help people for a month, 2 months, 3 months. We wouldn't typically allow someone to go beyond a month, 2 months, 3 months without requiring them to get financial advice, because effectively they're making a financial decision which in the long term can deplete their equity and actually leave them with nothing. And that's not good for them, and it's also not good for us. It's not good, because our objective is to promote home ownership. So we'd require them to get financial advice, and we'd then have a discussion with them. Look, if you can't afford this property, then it might be better for you to now cash in your equity and then buy something that's more affordable, downsize a bit. So there are lots of different options we discuss with them. What we wouldn't allow someone to do is to deplete all of their equity and then be left with nothing. Do you want to add anything to that, Raza? No?
There's still a problem. Even you're paying back by your partnership, you're paying back the same amount of value as you bought the house for it.
When someone is?
So, for example, even someone is buying your partnership, they pay the same price as you bought the house for it.
Right, so yeah. So our policy is to always offer to sell the property at our acquisition cost. And it's up to the customer to accept that or not. Yeah, so we don't revalue the property, because usually in the long term the property prices will go up. We don't revalue the properties to make it affordable so that in the long term you can afford to buy the house. Also, sometimes the property in the short term, sometimes property prices can dip. In those situations, we'll also offer to sell at the original acquisition cost. And again, it's up to you to buy or not to buy. Typically, we find that our customers carry on buying because they see this as their home. They see that they're on a long-term journey, and so they take the long-term picture. All right, we'll take last 2 questions. I think we had one there and one there.
I was going to ask you, are you looking to add any more products to Islamic finance, for instance, like car finance?
Like car finance?
Yeah, because obviously finance is mortgages.
That's right. Do you want to take that?
So we did look into launching a separate car finance product. We get asked about car finance quite a lot. And we actually decided to go a slightly different route. Now, if you imagine when you buy your house from a bank, you pay a certain rate. And when you want to take out car finance, you pay a completely different rate. And when you want a student loan, you pay another rate completely. Why should it be that way? It's still you. You're still the same person, the same credit. Why should you pay different rates for different assets? So one thing we're thinking about, and we're not quite ready to do this yet, but it's a consideration for the future, is imagine you've got this property, which is the most valuable asset, but it's completely dead. It's not utilized. Imagine if you could have a bank account, a debit card against your property. We've already got the notion of an equity buffer, where in times of need, you can release equity in your property to cover that rent. Imagine over time, if you could use your house as a revolving credit line. So you want to buy a car, you use your debit card, quote unquote, against your house, you take out £20,000 and you go and buy a car, and you're paying the same rate on that £20,000 as you are on your car, on your house. You want to send your son to university, you take out £10,000 from your house account and you send your son to university and you're paying the same rate as you are on your house. I think that's a fairer system, right? Why should you pay different rates for different products? So it's a consideration. It's what I see as, we see this as Islamic finance version 2.0. I see that as version 3.0, where you're really unlocking the full potential of your house, but we're nowhere near that yet. But it's a consideration, inshallah. What was the last question? Was it that one?
Does the rent review over time?
Oh yeah, great question. Yeah, so rent is fixed 1 year at a time, just like when you're renting from a landlord. At the end of each year, there's a rent review. And the way the rent review works is completely mechanical, so it's not subjective at all. Our tech reads in land registry information. It looks at sold property prices in the postal area of your property. And if property prices are going up, your rent will go up. And if property prices are going down, your rent can go down as well. and it's capped and floored. So your rent never moves by too much in any given year. So we've actually capped it and floored it so that the maximum your rent can go up in any given year means the impact on your total monthly target payment should never be more than 1 or 2%. Why have we calibrated it at 1 or 2%? Can anyone tell me?
The wage rate increase.
Wage inflation. So we've calibrated it so that your total target monthly payment should never move by more than 1 or 2% per year, which should correlate heavily with wage inflation. And what that means is, whereas with a bank mortgage, every 2 years you're forced to remortgage because your interest rate spikes up at the end of your fixed period, with our product, it should remain roughly constant affordability for you throughout time. So once you're in the property with us, you should be good, inshallah, for the rest of your life.
And again, if equity has increased, rent reassessment will take that into consideration as well. The recalculation will obviously be according to the equity.
Yeah. So as your equity goes up and down, your rent goes up and down with that. But then there's a rent review once a year to review the actual rental rate as well. But that's done completely mechanically based on property price movements. Okay, Jazakumullah khair everyone for sticking with us. MashaAllah, it's very, very late. If there are more questions, we're going to stick around a little bit longer, just come and tap us on the shoulder, inshallah. But I hope you found that useful. I hope, as well as finding out more about the Pfida product, I hope we've helped to arm you with the tools to understand all the different products as well, to understand what finance is and how finance can be a tool to help you achieve your aspirations, inshallah. So Jazakumullah khairah, thank you very much for sticking with us, and I hope you found it useful. Assalamu alaikum.